Something unfolded this week that deserves your full attention. And before I explain it, I want you to pause and really sit with this reality. In just 48 hours, more than $6 trillion in market value vanished. Not slowly, not over a few weeks or months, but in 2 days. The S&P 500 dropped by 10%. The NASDAQ officially slipped into bear market territory. And the VIX, the index that reflects how much fear is priced into the system, shot up to 45. The last time we saw that level of fear was back in March 2020, when the world had no idea how severe the global crisis was about to become. At the same time, oil prices crashed, copper declined sharply, and even gold, the asset constantly promoted by financial experts, macro analysts, and central banks as the ultimate safe haven during chaos, fell as well. Everything dropped together during a trade war that, according to nearly every economist, should actually push prices higher. So here is the question I want you to keep in your mind as we move forward. If tariffs create inflation, and inflation has historically supported assets like gold and commodities, then why did everything collapse at once? Why did the very assets designed to protect you in this type of environment fail to do their job? The answer is not what you're hearing on financial television. And once you truly understand it, it will completely reshape how you interpret every major market move going forward, not just this year, but potentially for the next decade. I've spent my entire career studying economic systems, not individual companies or short-term earnings reports, but the larger patterns that repeat over time. These patterns exist because human behavior doesn't change, debt cycles don't change, and the mechanical relationship between government policy and asset prices remains consistent. What we're witnessing right now may feel new, and in some ways the trigger is new, but the underlying process is decades old. The chain reaction playing out today has been repeating in different forms for over 50 years. Once you understand how this chain works, you stop reacting emotionally to daily headlines and instead start positioning yourself based on where the system is actually heading. So let's go back to the beginning of this specific event. On April 2nd, the United States announced a sweeping policy described as a universal tariff on imports. This meant a baseline 10% tax applied to goods coming in from every country, along with even higher reciprocal tariffs on around 90 nations. The official reasoning sounded straightforward: protect domestic manufacturing, bring jobs back home, generate government revenue, and correct what policymakers described as years of unfair trade practices. Markets didn't take long to react. Almost immediately, prices started falling. Then, the very next day, China responded with a 34% retaliatory tariff on American goods, and within just 2 trading sessions, the sell-off intensified dramatically, turning the numbers I mentioned earlier into reality. Now, the common explanation you'll hear is simple. Markets dislike uncertainty, tariffs create uncertainty, so markets fell. That explanation isn't entirely wrong, but it's incredibly shallow. It's like saying water is wet when your house is flooding. It describes what's happening on the surface, but it doesn't tell you why it's happening or how bad it might get. Without understanding the actual mechanism underneath, you have no way of knowing how deep this situation goes, how long it could last, or what actions actually make sense. So let's break down the real mechanism. A tariff is, at its core, a tax. That's not a political statement. It's just a definition. When a government imposes a tariff on imported goods, someone has to bear that cost. The critical question is, who actually pays it? Most people assume it's the foreign producer, that a Chinese manufacturer or a European company simply lowers its prices to stay competitive. But the data tells a very different story. Studies from the Congressional Budget Office and multiple Federal Reserve banks consistently show that foreign exporters only absorb a small portion of the cost, somewhere between 4% and 10%. The overwhelming majority, roughly 90% to 96%, gets passed on to American importers and ultimately to American consumers through higher prices. In practical terms, this means tariffs function as a widespread consumption tax within the domestic economy. Every dollar collected by the government through tariffs is a dollar taken out of household budgets or business profits. This has direct and immediate consequences. Consumers have less spending power, companies face tighter margins, and expectations for future earnings start to decline. And since stock prices are fundamentally based on future earnings, essentially the present value of what companies are expected to generate over time, when those expectations drop, stock prices follow. This isn't about panic or emotion, it's basic arithmetic. But this is where the situation becomes more complicated and far more dangerous. Tariffs don't just reduce growth, they also increase prices. When the cost of imported goods rises across the economy, the overall price level rises with it. Even the Federal Reserve has acknowledged this directly. Jerome Powell stated in recent meetings that rising consumer prices are being driven in part by inflation in goods, which has been strengthened by the impact of tariffs. The Fed has already adjusted its forecasts, raising inflation expectations while lowering projections for economic growth. What you end up with is a very specific and difficult environment where prices are rising, but economic activity is slowing at the same time. This condition has a name: stagflation. And stagflation is one of the most challenging environments a central bank can face because the usual tools stop working effectively. Think about the position this puts the Federal Reserve in. If it lowers interest rates to support growth, it risks worsening inflation because cheaper borrowing can push prices even higher. On the other hand, if it raises rates to control inflation, it risks slowing the economy even further by making borrowing more expensive for businesses and consumers. In other words, every option creates a trade-off that makes part of the problem worse. So what does the Fed do? It waits, it pauses, it acknowledges that uncertainty is high, which it is, and chooses not to act aggressively in either direction. And this leads us to something that many investors are still underestimating. For roughly 15 years, from the financial crisis in 2008 through about 2022, markets operated under a powerful assumption. Whenever things got bad enough, the Federal Reserve would step in. It would cut interest rates, inject liquidity, and stabilize the system. This pattern became so consistent that it earned a name: the Fed put, the idea that the central bank effectively provided a safety net for markets. Investors became conditioned to buy dips, believing the Fed would always step in to prevent major losses. But now, that assumption is being challenged in a very real way. Not because the Fed doesn't want to support markets, but because it may no longer have the flexibility to do so. When inflation is already elevated and tariffs are pushing it even higher, cutting rates is no longer a straightforward solution. The safety net that investors have relied on for years is no longer guaranteed. And when markets begin to realize that the protection they counted on might not be there, the adjustment doesn't happen slowly, it happens suddenly, exactly like we saw this week. But even that is not the full picture, because there's another layer beneath all of this. And it's the one that explains the most confusing part of the entire situation. The reason gold dropped alongside everything else over the past 2 years, as gold surged from around $2,000 per ounce to its peak near $5,595 in early 2026, a massive wave of money flowed into the gold market. But it didn't all go into simple long-term holdings. A significant portion, around $70 billion, according to available data, went into exchange-traded products, many of which were leveraged. These are financial instruments designed to amplify returns, often offering 2 or even 3 times the daily movement of gold prices. On the way up, they make gains look impressive. But on the way down, they create a chain reaction that most investors don't fully understand until it's already happening. These leveraged products require constant adjustment. When gold prices fall, even slightly, these funds are forced to sell gold futures to maintain their leverage ratios. That selling pushes prices lower, which then triggers more selling. At the same time, investors using borrowed money begin to receive margin calls, forcing them to liquidate positions across their portfolios. And here's the key point: when margin calls hit, investors don't carefully evaluate which assets are fundamentally strong or weak. They sell whatever they can as quickly as possible just to meet their obligations. This creates a cascading effect across the entire market. Gold gets sold, but so do stocks, oil contracts, copper futures, and any other liquid assets that can be converted into cash. This type of selling has nothing to do with whether an asset is overvalued or undervalued. It's purely mechanical. It's driven by leverage, not logic. When forced liquidation begins, price becomes secondary to urgency, Assets are sold at whatever price buyers are willing to pay in that moment. And this is why everything fell together. It wasn't a coordinated judgment that every asset had suddenly become less valuable. It was a liquidity event, a system-wide unwinding driven by the structure of modern financial markets. Once you understand that, the confusion starts to fade. What looked like a contradiction, safe assets failing during instability, was actually a predictable outcome of leverage being flushed out of the system. Now, to understand where this could lead, it helps to look at history. One of the most relevant parallels comes from the early 20th century. In 1929, the United States had strong economic growth, high asset valuations, and a labor market that appeared stable. Then came the Smoot-Hawley Tariff Act in 1930, which significantly increased import duties. It wasn't introduced at the beginning of the crash, but during it, with the intention of protecting domestic industries and reducing unemployment. Instead, it triggered immediate retaliation from trading partners. Global trade collapsed by about 65% between 1929 and 1934. Corporate profits shrank dramatically, unemployment surged to around 25%, and what started as a financial downturn turned into a prolonged economic depression. Now, I'm not saying we're heading for an exact repeat of the 1930s. Today's financial system has more safeguards, better tools, and more coordination. But the underlying mechanism is the same. Tariffs increase costs, retaliation reduces trade, demand weakens, earnings fall, and the central bank's ability to respond becomes limited. That combination creates a slow, difficult environment that doesn't resolve quickly. There's also a more recent comparison that deserves attention. Just last year, when a previous round of aggressive tariffs was announced, what was referred to as Liberation Day, the S&P 500 dropped by about 10% within 2 trading sessions, almost identical to what we saw this week. At that time, some of those tariffs were paused or softened, and markets partially recovered. This led some traders to believe in a pattern, the idea that policymakers would always step back before causing too much economic damage. On Wall Street, this idea even got a nickname. But building an investment strategy around assumptions about how a specific individual might react under pressure is risky. That's not economic analysis, that's speculation about human behavior. And behavior is far less reliable than structural forces. Instead of trying to guess what decision makers might do next, it's far more useful to focus on what the system itself is doing. Right now, those forces are clear. Tariffs are pushing prices higher, the Federal Reserve is limited in its response, corporate earnings are under pressure, leverage is being unwound, and global trade is beginning to contract. These forces don't change based on headlines or speeches. They operate beneath the surface, shaping outcomes regardless of short-term narratives. So what happens next? This is where second-order effects start to matter, and this is where most commentary begins to fall short. The first major effect is the repricing of global supply chains. For decades, companies built their operations around predictable trade conditions. They sourced materials from specific countries, optimized costs based on stable tariffs, and designed production systems around efficiency. Those assumptions are now being disrupted all at once. And here's the critical point. Companies cannot rebuild supply chains overnight. Shifting production, finding new suppliers, and reorganizing logistics takes years, not weeks. During that transition, costs remain elevated because businesses are forced to operate in less efficient ways. This means the inflation created by tariffs doesn't disappear quickly. It lingers. In fact, it can persist longer than expected because the disruption to supply chains adds another layer of cost pressure. This is why several economic forecasts suggest that the inflationary impact of current trade policies could last for multiple years, not just a short-term shock. And as long as inflation remains elevated, the Federal Reserve remains constrained. The second major effect involves the US dollar, and this is where things become more nuanced. In the short term, during periods of market stress, global investors tend to move money into US assets, especially treasury bonds, because they are seen as safe and highly liquid. This creates demand for the dollar, which can strengthen it temporarily even as markets are falling. We saw this dynamic play out clearly during the early stages of this week's sell-off. But over a longer time frame, a different trend begins to emerge. When a country imposes broad tariffs, disrupts established trade relationships, and uses economic pressure as a negotiation tool, It introduces uncertainty into its own system. And here's the key. Predictability is what supports a currency's role as a global reserve. It's not guaranteed. It's earned over time through stability and consistency. When that predictability starts to weaken, even slightly, it can slowly reduce confidence in that currency. This doesn't happen overnight, and it doesn't cause immediate collapse, but it can gradually erode the premium that the dollar enjoys in global markets. Over time, that shift can have meaningful consequences. And then there's the third second-order effect, which is perhaps the most important for anyone thinking about their financial future. When governments create an environment where growth slows but inflation remains high, when they effectively produce stagflation, the historical response has been consistent. Eventually, central banks step in and increase the money supply, not because they want to, but because the pressure becomes too great. Prolonged stagnation combined with rising costs creates social and political stress that demands action. And the primary tool central banks have is liquidity, printing money, lowering borrowing costs, and trying to stimulate activity. The exact timing of that shift is uncertain, but the direction is not. More money enters the system, real returns on traditional financial assets decline, and the prices of tangible, limited assets begin to rise. This is where the distinction becomes critical. What we're seeing in gold right now is not a failure of its long-term role. It's a short-term effect of forced selling. The structural forces, rising debt, monetary expansion, gradual currency pressure, are still in place, and they point in a very different direction over the medium term. This brings us to the most important part of all of this, what it actually means for you and how you should be thinking in a moment like this. The first thing to understand is the difference between price and value, because they are not the same thing, even though they're often treated as if they are. An asset can fall sharply in price without its underlying value changing at all, especially when that decline is driven by forced selling rather than a shift in fundamentals. Imagine a house that is worth $500,000 based on its location, condition, and long-term demand. If the owner suddenly needs cash and sells it for $400,000, the price has changed, but the intrinsic value hasn't. What you're seeing in markets right now is a similar dynamic playing out across multiple asset classes. The key question is not whether prices are falling, but why they are falling. If they're dropping because future earnings or long-term demand have genuinely weakened, that's one scenario. But if they're falling because leveraged positions are being unwound and liquidity is being drained, that's a completely different situation. And right now, much of what we're seeing falls into that second category. For assets like gold, and even for broader real assets, the fundamental drivers haven't improved over the past week. They've arguably become more supportive. Rising tariffs, constrained central bank policy, slowing growth, and persistent inflation all reinforce the long-term case for assets that preserve purchasing power. What's happening in the short term is a distortion caused by the mechanics of the financial system, not a reflection of those long-term fundamentals breaking down. That distinction matters because it determines whether you react emotionally to price movements or position yourself based on where the system is actually heading. The second thing you should be paying close attention to is the Federal Reserve, not in terms of the next statement or meeting, but in terms of when it is forced to change direction in a meaningful way. At some point, if economic conditions weaken enough, the pressure to support growth will outweigh the need to control inflation. When that shift happens, it won't just affect one part of the market, it will trigger a chain reaction. The dollar could weaken, real interest rates could fall, and liquidity would begin to flow back into the system. The same forces that are currently pushing prices down would start working in reverse. Historically, these turning points don't unfold slowly. They happen quickly, and the majority of the gains tend to occur early in the move. Investors who are already positioned before the shift benefit the most, while those waiting for clear confirmation often enter after much of the opportunity has passed. That's why understanding the underlying mechanism matters so much more than reacting to headlines. And this leads to the third point, which may be the most difficult to act on because it goes against natural instinct. The worst investment decisions are usually made at moments when everything feels certain, when the narrative is so strong, so widely accepted, and so constantly repeated that questioning, it feels almost irresponsible. Right now, the dominant narrative is clear. Markets are falling, trade tensions are escalating, recession seems likely, and the safest move appears to be stepping back and waiting for clarity. There's truth in that perspective, but it's incomplete. It focuses entirely on